Hey everyone, welcome back to my channel. If you're new here, I'm Lou, an independent financial advisor, and I'm all about helping you achieve financial stability and well-being. Today we're diving into an important topic and one that's been requested several times by those of you who've been part of an employee share scheme. We're talking about capital gains tax, CGT, when you sell those shares. Whether you've been awarded shares through an employee share ownership plan, an ESOP, a share incentive plan, an SIP, or another scheme, it's essential to understand how CGT can impact your earnings when you eventually sell. So let's break it all down. First off, what exactly are employer-employee share schemes? These schemes allow employees to buy or be awarded shares in the company they work for. Some popular schemes include Save As You Earn, SAYE or ShareSave, Share Incentive Plan, SIP, Company Share Option Plans, CSOP, or Enterprise Management Incentives, EMI. Each scheme has its own set of rules, but the key takeaway is that they give you a stake in your employer's success by offering discounted or free shares. Sounds great, right? But here's the part where the taxman comes in. Capital gains tax, CGT, is triggered when you sell your shares at a profit, basically when the selling price is higher than what you originally paid. For example, let's say you bought shares under a Save As You Earn scheme. You paid £10 per share, and now, after a few years, they're worth £20 per share. If you decide to sell, that £10 per share profit could be subject to capital gains tax. The rate of CGT you pay depends on your overall income and which tax bracket you fall into. Basic rate taxpayers pay 10% on any gains above your CGT allowance, and higher and additional rate taxpayers pay 20%. The current CGT allowance is £3,000 for the 2024-25 tax year, so if your total gains in a year are below this threshold, you won't have to pay CGT at all. Here's the good news. Some share-safe schemes come with tax advantages that can help reduce or even eliminate your CGT liability. For instance, shares acquired through a share incentive plan, an SIP, might be exempt from CGT if you hold them for a certain period. Similarly, if you've been awarded shares through an enterprise management incentive, an EMI, you might qualify for entrepreneur's relief, meaning you could pay just 10% CGT on gains up to £1 million. These schemes offer significant benefits, so it's important to check the specifics of your plan. If you want to reduce your CGT bill, here are a couple of planning tips. Offset losses. If you've sold other assets at a loss, you can use that loss to offset your gains and reduce the amount of CGT you owe. Use your ISA allowance. You could sell some shares and reinvest the money into an ISA where future gains would be tax-free. Spread sales over 2 tax years. By spreading the sale of shares across different tax years, you can take advantage of your CGT allowance each tax year. To wrap up, understanding how capital gains tax works when selling shares from an employee share scheme can help you plan better and keep more of your hard-earned money. But remember, everyone's situation is different and tax rules can change, so it's always a good idea to consult with a financial advisor. Get in touch for a free consultation.